banks don't deal with, you can't go to HDFC and get an unsecured loan, or it'll be a very small, minuscule amount.
But I think why it works better when it comes to NBFCs is that the risk that the bank is not willing to take.
Right.
That is what the NBFC takes.
So this is a huge number, right? We're looking at huge numbers, huge amounts of gold being used as collateral.
Indian households, again, there is a little bit of a stigma still in terms of giving your gold away to take a loan. And because it has that character, a lot of people will do whatever it takes
to not give that gold away.
Yeah, to get it back. So to repay the interest and get it back.
Okay. I'm assuming from what I understand that, or at least what it seems like from the outside, is they're a highly profitable company.
Yeah. Now, that's the tricky part about NBFCs, right? How do you determine profitability? And
Correct.
It gets a little tricky.
This episode of Taking Stock is brought to you by Paterson. Okay, hello and welcome to yet another episode of Taking Stock. This is a weekly podcast where every week we pick one company, one stock and dive into it. This week we're talking about Muthoot Finance. Is that the right way to pronounce it?
Yeah.
Muthoot? Muthoot. Okay, so first thing that I want to start with, right, and it's confused me a little bit, where it says RBI announced something in 2023 which says risk weights on unsecured consumer credit cards and loans to NBFCs have increased. Is that correct?
Yeah.
What does it mean?
Okay, so we'll have to do.
So it is complicated, right?
It is.
Okay.
It is.
I was questioning my intelligence a little bit there.
So, see, basically what happens is when a bank is lending,
Okay.
right, it needs to keep a certain amount of capital aside. Now, the capital required is equal to the loan amount
Okay.
multiplied by the risk weight
Okay.
multiplied by capital adequacy ratio.
Okay. What does that mean? Okay. Fair enough.
Broadly.
This is by law.
Yeah. No, not by law. This is a formula
Okay.
of how to calculate this.
Okay. Fair enough.
How much capital is required.
Right.
Right. Capital adequacy ratio is something that is prescribed. Like international norms say 8%, India says 9%, a little more conservative.
Okay.
Basically, what you want to ensure is, I'll sort of step back and give you a simple example, right? Now, there is, bank has 100 in equity.
Okay.
Equity money, which is raised in a bank,
Right.
their own equity capital,
Right.
is about 100.
Right.
If the capital adequacy ratio prescribed for simplicity, say it's 10%, that means they can take deposits worth $900.
$90, you mean?
100 is the equity, 900 can be deposits.
Okay.
So 1,000 are the assets.
Okay, understood.
So basically, what happens is, out of the 1,000 which are your assets, and by assets means amount lent out.
Correct.
For a bank.
Right. Understood,
Deposits is the deposits is taken from customers. 100 is equity, 900 is deposits taken, 1,000 it is lending. Out of that 1,000, if 50 defaults,
Right.
the capital or the equity reduces by 50.
Right.
So your deposits are safe.
Understood. You're not losing people's money essentially.
So that is the capital adequacy ratio.
Understood.
So a bank is supposed to keep, say, for example, 9% or 10% capital adequacy ratio.
Right.
Now the capital required will also change depending on where you're lending.
Correct.
Because if you are giving it to a guy who's given you collateral, for example, he's given you his house and said, if I default,
it's a
you take the
secured
house.
loan or
It
whatever.
is secured. If it is unsecured, there is a higher risk to it.
Correct.
So you need to adjust for that.
Fair enough.
That is the risk weight.
Understood.
So basically, going back to the formula, and we can put it up here, which is capital required is equal to loan amount into risk weight into capital adequacy ratio.
Okay.
Capital adequacy ratio set, you're adjusting the parameter depending on the risk of the loan that you're giving out.
Understood.
And the loan amount, which is fairly simple.
Understood. So now going back to this statement.
Yeah.
So what does that mean?
So risk weights have been increased on unsecured consumer credit.
Credit cards and loans.
On credit cards and loans that banks give to NBFCs, which further disburse it to people.
Understood.
Now that ratio has been increased for consumer credit from 100 to 125%. Credit card is 125 to 150, and similar increase in NBFCs.
Right.
Also. So basically, the amount of safety nets that banks have to create increases because of this.
Fair enough.
For unsecured lending.
Right.
Similarly, just to give you an example, something where, for example, if it is a home loan, the risk weight is much lower.
Okay.
For a gold loan, it is 50%.
Right.
For these loans, it is much higher. So imagine this, for a bank, in order to lend 1,000 in assets, for example, they'll have to create 100 in equity.
Correct.
If they are doing more unsecured lending, they will have to increase the equity proportion.
Right.
Now, inherently what happens is basic capital allocation funda is that debt is cheaper.
Right.
Equity is more expensive. So debt, for example, cost of deposits is, for example, 6%.
Right.
The cost of equity will be equivalent more or less to the return on equity that investors expect out of
Correct.
it, which is roughly 15%.
Right.
Let's assume. So the cost of equity is much higher. So if the bank had to earlier raise X amount of equity, it could raise a certain amount of deposits on top of that, or take from RBI or whatever, and lend it out for a certain return.
Correct.
Now that equation changes.
Oh, understood. Now that makes sense.
So again, just to put it in perspective, say for example, earlier the ratio was 90:10.
Right.
Of deposits versus capital, or debt versus capital.
Correct.
Now it will become 87.5 to 12.5.
Understood.
So the cost of funding increases.
Correct.
Now what happens is, if it is unsecured lending, you could probably, on that same example, if you raised, for example, 12.5 crore equity instead of 10 crore, right? You could do 100 crore of unsecured lending, and get a 15% rate on it, right? Roughly you will make 15 crore.
Correct.
However, when it comes to home loans, because the weight is lower, on 12.5 crore equity, you can lend up to 357 crore.
Correct.
Even if it comes at a 9% interest rate, you make 32 crores.
You still make more.
So the return on capital deployed by a bank will be much more for secured lending than for unsecured lending.
Understood. This episode of Taking Stock is brought to you by Paterson. So, okay, now when we're talking about Muthoot over here, I'm assuming. So this was announced by the RBI in 2023, right? And this is a huge benefit for Muthoot as a company.
Yeah. So it's a little bit of a first and second order impact.
Okay.
One is, as soon as this happened, the natural math or the natural mind for a banker taking decisions on where the lending should be done would be to cut out on unsecured lending.
Right.
Just purely basis the math I just explained. So if you look at the damage done because of this came out in November 2023. By mid 2024, personal loan growth had collapsed from like 22% CAGR in the last 5 years to just about 8% YOY.
Right.
So massive fall. Credit card loans were doing about 25% growth on average. That came down to about 10-11%.
Right.
Bank credit to NBFCs was 25% in the year before. It actually degrew by 7%.
Right.
So banks completely reject their strategy of where the money is going. Right. Now, why did the RBI do this in the first place? They did this for, number one, to cool down the unsecured lending market a little bit.
Correct.
Because it is unsecured, it is inherently riskier.
Yeah.
So you want to cool it down because it's growing at 30%.
Right.
So you want to cool it down. Second is for risk management.
Okay.
And to prevent asset quality deterioration, because unsecured lending has a higher chance of defaults because there is no security. And lastly, to curb aggressive fintech expansion into unsecured lending.
Right.
Buy now, pay later type.
Correct. So I have a very fundamental basic question here, right? Yeah. So are NBFCs only dealing with unsecured loans?
Good question. Mostly, yeah.
Because, okay, I mean, if we take a step back, banks don't deal with, you can't go to HDFC and get an unsecured loan, or it will be a very small, minuscule amount.
No, but you can get a home loan. See, you're
understood. Okay, so
that is unsecured. Right? If you want to buy a home, what are you giving? You will give a certain down payment.
Correct.
But I think why it works better when it comes to NBFCs is that the risk that the bank is not willing to take.
Right.
That is what the NBFC takes.
Yeah.
That's why I said maybe a little higher in terms of risk, but you can't. There will be a lot of NBFCs who also take collateral. So no.
Understood. So it will be.
So like, let's look at this. Let's look at Muthoot as an example.
Okay.
What is Muthoot's business model? So they give out loans. If you need a loan tomorrow,
Correct.
you will come to me. You will say, boss, I don't have any money. I don't have any assets to give you. My wife's jewelry is there. Here, take this
gold loan.
Gold loan. And you get a loan. In this case, what is the security for a Muthoot? It is the underlying gold.
Correct.
So there is a securitization process happening in this case.
Understood.
Yeah.
So Muthoot's entire business model is based on gold loans only?
They have some other stuff as well, but
primarily majority is gold loans, right?
Yeah.
And so, I mean, I think this is something that is very important that we should talk about. I think we had done a small video on this a couple of weeks ago as well, about India's love for gold and gold loans, right? And just like, if you can explain to everybody listening how the economics of gold loans work. Because I think this is quite established that Indians are hoarders of gold, right? We love gold more than anything else.
Yeah.
And I don't think there is any questioning that philosophy. So now, how does the economics of the gold loan business work? And then again, obviously, how does it work for Muthoot?
Yeah. So one is, taking a step back, just want to sort of make clear the connection between what happened with RBI and Muthoot, right?
Okay.
So Muthoot, number one is that risk weight for gold loans is about 50%.
Correct.
Versus the 125, 150% that we were talking about earlier.
Right.
Secondly, what happens is when banks stopped diverging their assets towards these funding avenues,
right.
As a consumer, I didn't have access to that credit any longer. So as a consumer, I started giving my gold and getting
correct.
So that's how Muthoot benefited, right? Because lower risk weight and because consumers left with this option,
right?
Which ties into how we are holding gold.
Understood.
Holding gold. So just to give you some numbers, because these are very interesting numbers, estimates, because nobody knows the real number.
What of how much gold is there in the house?
Yeah, even the family members won't exactly know the value of the gold. So Indians, again, it's an estimate, but Indians approximately hold about 25,000 tons of gold. These are households.
Right. This is not the RBI.
Not the RBI. So this is actually, interestingly, 40 times more than what the government holds. That's one interesting number. Second interesting number is that this gold will be worth approximately 250 lakh crore, which is roughly $4 trillion,
right?
Which is about 90% of India's GDP.
Okay.
That's the second interesting number. Third interesting number is it's also more than 10% of the world's stock of gold.
Okay. So what the Indian households have.
Households. So roughly, to put into context now with how it comes down to lending or using this as collateral, you've got say, for example, about 1.25 lakh crore of gold.
Okay.
Right? Sorry.
So, let's... okay.
Sorry. 18 to... out of the total gold, which is about 250 lakh crore,
right?
18 to 25 lakh crore is the gold that is used for collateralizing for taking loans.
Understood.
Right? Out of this, about 7 to 10 lakh crore is the organized market. 11 to 15 is the unorganized market.
Okay.
Right? Now, out of the 7 to 10, NBFCs and banks, NBFCs would be about 60% plus. Banks would be about 40% and lower.
Right.
That's the overall split. Now, while we spoke of that anchor number being 18 to 25 lakh crore.
Correct.
Out of 250 lakh crore.
Right.
Right. So,
less than 10%.
Yeah. That 18 to 25 lakh crore also, I'll just give you some context, which is overall the retail outstanding loan right now would be about 100 lakh crore.
Okay.
Out of the 100 lakh crore, about 32 will be home loans. 15 about personal loans. Organized gold will be 7 to 10.
Right.
So that's how it stacks up. Auto will be about 7, 8.
Understood.
So this gives you a picture of how much gold is relevant or not from the overall perspective.
This episode of Taking Stock is brought to you by Paterson. Okay, I mean, so this is a huge number, right? We're looking at huge numbers, huge amounts of gold being used as collateral. So I think most people, if today Sharma uncle and Sharma auntie are holding gold in their house. One is it's an investment where when times are tough, we can use this, right? But here, according to what you're saying, there is a huge amount of people or families or households who are also using this as a collateral, right? Now, how does a Muthoot benefit from this?
So see, one thing is that, again, like, I think I'll go back to the question you asked about whether this lending is secured or not.
Right.
In this case, it becomes secured immediately.
Right.
Because there is collateral which is available in gold.
Correct.
You don't return the money, I take the gold,
Keep
I
the
sell
gold,
it,
yeah.
and there is value for that underlying gold. One of the things that has, and that is the fundamental benefit of it, right? Because there is security.
Right.
And why that security is important is because Indian households, again, there is a little bit of a stigma still in terms of giving your gold away to take a loan.
Okay.
Because it is a household asset, it is your last resort.
Yeah.
I don't have anything left, I will give away jewelry or gold.
It's an emotional attachment also,
there is a
usually.
Very large emotional attachment. And so it is almost like saying that this is the last resort.
Correct.
And because it has that character, a lot of people will do whatever it takes
to not give that gold away.
Yeah, to get it back. So to repay the interest and get it back.
Okay.
So the amount of defaults inherently will be lower in gold loans versus anything else.
Correct.
So that's how it benefits Muthoot in one case. Second is because the unorganized market is so large, generally the India trend is that unorganized to organized shift is happening.
Correct.
People want to bank or lend or whatever with people who are organized, and you have a recourse mechanism.
Right.
Tomorrow, if you go to a jeweler and just get some money for the gold and he disappears tomorrow, where are you going to go?
Correct.
Right. That is not a secure form of lending.
Right.
Even from the borrower's perspective.
Right. Right.
So that's the second way Muthoot benefits. The third way Muthoot benefits is plainly because of luck, I feel.
Okay.
Because one, the RBI announced this and funding dried up for people who needed it. So gold loans started increasing. So the third point has three sub-points. One is the RBI directive. The second point being that the value of gold itself shot up. So if you look at the last couple of years,
it's
the
been
way
soaring,
gold has risen, it is insane how much the amount is increased. And the third thing is that also brings about, the third point being that there is an interesting number which is something known as a substitution rate.
Okay.
So which is basically on maturity of your loan. You can basically roll over the loan. You don't have money to pay. I am Muthoot. You've come, you've given me 100 rupees of gold.
Right.
And you've taken that loan amount. You are supposed to pay 115 1 year down the line. Right. Instead of paying me the 115, you roll over the contract. So basically you say, I'm keeping the money, you keep the gold. You're extending the loan period.
Understood. And it works because gold prices are going up.
Yeah.
Okay, that makes sense.
So because gold prices are going up, it works because your interest sort of gets covered in that process, and you're like, okay, my next year's repayment is also secured. And because even if it is, you've given the collateral, anyway, that gold is not being used.
Correct.
It is put away in lockers. So less than 20% of the value has been pledged. So 80% of the gold is just lying around.
Correct.
So that is not gold you require. Right. So you're okay keeping that as collateral.
Correct.
And keep taking loans.
Right.
So the substitution rate on gold loans is said to have been about 95%.
Oh, okay.
That's a supremely high number.
Right.
So all these factors put together put Muthoot in a position where it benefits.
So they are, in India currently, they are the largest gold loan NBFC, right? Is that the right term to use? Gold loan NBFC? Or the gold loan provider?
Yeah.
Let's put it that way, right?
So here's the number, right? The total loans they've provided basis gold is at 1.25 lakh crore.
Oh, wow. Okay.
Now, again, to go back to those numbers, just a refresher. We were talking about the industry being 18 to 25 lakh, 7 to 10 lakh being organized, 11 to 15 being unorganized.
Correct.
Muthoot is at 1.25.
Right.
So it is the single largest player. After that, the far second would come to Manappuram. And then you've got a long tail of players.
Right. So what is it? Is it just that they were the first into this, or they grew at a faster pace? What's worked for them? Something's gone right for them to be the
Yeah.
leader and a leader by such a big margin.
So one is, you're right, the history and their presence. I mean,
Right.
they're a very, very old company.
It started as a family-owned business, so it's still
Yeah,
run
yeah,
as a very close-knit family-owned business.
so
right?
very old business, more than 100-year-old
Right.
history. So that's been there, and that has also created a sort of brand and custody moat around it,
Right.
which is important because at the end of it, understand the emotional attachment to that gold, and hence you need a trusted partner to bank with.
Right.
So people would end up going to a Muthoot over somebody else because
It's
there
just
is
the
that
trust, yeah.
and that is a very important factor when it comes to this.
True.
Because unsecured loan, the bank has to trust you.
Yeah.
In a where you're giving the gold, you also have to trust
the person. Yeah. True.
So that's a big deal. Second is, which is again virtue of their existence as well, is the branch network.
So they've got their branches everywhere.
Yeah, so they've got about 5,000 odd branches, which covers a lot of pin codes across the country, through rural, semi-urban. There's a lot of branches basically. And again, here you need a physical branch because you actually want to see that there is this functioning office.
Right.
They are registered.
Again, it gives you more credibility. Just
it's
presence.
Not a scam. It's going to be put in a safe place. So all that gold then it requires branches. You can't say,
it's not some sketchy guy on the phone basically saying, give me your gold and I'll give you money and we'll deal with it later.
Well, sir, loan chahiye, that's not how it works.
Correct.
So that becomes an important figure. And the third, purely because of how much they have, despite being an old company, they have invested in, say, tech, which a lot of NBFCs have started doing. A lot of companies we analyze also, whether it's in home loans or whether it's any other segment, they're looking at operational efficiency improvement to quite an extent. And that may be from just purely reducing the turnaround time, for example.
Correct.
You walk into a branch, how much time does it take for me to verify who you are, grab your CIBIL score up, whether you're legit or not, and then give you a loan.
Process the loan basically.
Process it. Or figure out that, okay, if you want a 100 rupee loan, how much gold are you giving me? And whether that can change or not, or what is the interest rate and stuff like that. So while it used to take an hour earlier, the processing time has reduced to as little as 10 minutes now. So that's a huge jump. Other thing is that how many gold applications can you digitize fully and not do pen and paper and stuff like that for? That number currently stands at about 35% in the case of Muthoot. It used to be at about 20% a year earlier. So they're getting really aggressive on that. And the third is that on the same day, to be able to disburse, you need sort of office personnel, etc., to also be in sync with this entire system. So they're actually processing about 1 lakh plus daily applications across their branches.
Right.
Why this is important is because at the end of it, it improves your, there is a cost as well associated with this entire activity. If you're able to reduce this cost, you're able to maximize the spread between how much you're able to get as interest from customers and how much you're paying in order to get the deposits in the first place.
Correct.
Get the money, not deposits. So, and why NBFCs are focusing more on this is because cost of funds for a bank are inherently much lower at say 6% because there are retail participants depositing their money with a bank.
Correct.
In the case of NBFCs, their source of funding is the bank itself, or certain external borrowings or debentures or bonds that they issue. So the cost of funding is higher for an NBFC.
Understood.
Agreed that the rate they get from borrowers is also higher. But the risk is also higher.
Correct.
So operational efficiency becomes very critical for NBFCs to focus on.
Right. So, okay, so let's look at that.
Last point is they're also south-based.
Okay.
So while we've sort of focused on saying that India is holding onto a lot of gold, there is enough evidence that south of India is even more a holder compared to the rest of the country, where estimates range from all the way from 32% to 40% of the overall gold in Indian households to be concentrated in the south.
Okay.
And this one being a south-based company, there is...
I'm assuming they also have a higher concentration of branches and network, etc. in the south.
So highest concentration is south, west is sort of west and north are fast growing, east is still minimal.
Right. This episode of Taking Stock is brought to you by Paterson. So what does Muthoot look like in terms of just their general financial numbers? I'm assuming from what I understand that, or at least what it seems like from the outside, is they're a highly profitable company.
Yeah. Now, that's the tricky part about NBFCs, right? How do you determine profitability? And
Correct.
It gets a little tricky. So I'll just roughly lay out like how to look at it, right? So the yield that you would get by giving loans would be, for example, 18% on gold, right? Now, the cost of funds would be roughly 8%, 7 to 8%.
Right.
Because you have this thing, you're sourcing from banks 50 to 60%. You're getting about 20-25% from non-convertible debentures.
Right.
Then there's 10 to 15% from external borrowings, which are basically just bonds,
correct.
also given to foreign entities and stuff. And there's 5 to 10% from commercial paper. That's the spread. So the blended rate comes to about 7.4.
Right.
Now that leaves the company with a spread of about 11%.
Okay.
Right. In this 11%, they have to do two things. One is manage operating expenses, which we covered as efficiencies.
Right.
That would come to about 3 to 4%. And then provisioning, because loans will go bad and they have to keep some capital aside. So that will be 0.5 to 1%. So the core net interest margin is basically your gross interest received minus all these things, comes to about 7.5-ish%.
Okay.
Reported number is slightly, it comes to about 10%.
Okay.
My bad. So it roughly comes to about 10%.
Right.
So basically, in a nutshell, supremely profitable, which is also reflected in their return on equity. So if I look at the return on equity for FY25, it's at a 19.7%. Just to give context, return on equity for HDFC Bank, 14.5%. Bajaj Finance, 11.5%.
Right.
Manappuram, 10%.
Right.
So in terms of profitability, they are higher. This can be attributed to, one, these are not directly comparable, right?
Correct.
Because your gold prices have also shot up, which has benefited you.
Right.
So that is a massive tailwind. NPAs would have also reduced because of that. Operational efficiency is higher. Also, cost of funds also differ between NBFCs depending on their credit rating. These guys have also seen a credit rating upgrade recently, which has also reduced cost of funds.
Right.
So higher the credit rating, lower the cost of funds.
Yeah, fair enough.
So all these things have benefited them gravely. And again, the amount of equity they have to park is at, because of the risk weight, is lower because they are gold loans.
So it's more secured than unsecured.
Compared to a Bajaj Finance who's doing consumer credit, which is at a 125% risk weight versus these guys at 50%.
Right.
So all these put together make them extremely sort of lucrative at this point in time. But I would also attribute a lot of the glossy numbers.
Because the gold price is going up?
Yeah, because the market is in their favor.
Right.
The RBI directive, gold prices, etc., everything coming together. See, the AUM growth used to be around 20% earlier. After the RBI tightening, it shot up to 45%.
Right.
In fact, their PAT growth in half of FY26 was 90%. 90% PAT growth. They've almost doubled their PAT growth, which is almost at the upper end of what the management was guiding for the whole year.
Correct.
So they've had a massive luck or whatever. They've been in the right place at the right time.
Correct.
So I kind of wouldn't take these numbers as normalized numbers.
Right.
These are sort of super normal numbers.
Correct.
But even in normal circumstances, with a return of equity of 18 to 19%, gross NPAs of about 3%, net interest margin of about 11.5%, they're good.
Understood.
Numbers are great.
This episode of Taking Stock is brought to you by Paterson. So, okay, one question that I genuinely have is that how do you even begin to value a company or, estimate valuations for a company like Muthoot? Because one, they're in a very different space and a lot of what they do depends on gold prices going up and down, right? Which is a dynamic thing and will remain dynamic forever. Secondly, the second competitor that is there is not even close. So how do you even begin this process?
So one is that you establish that NBFCs generally are valued on a price to book.
Okay.
So you take the book value and give it a multiple, because the book is what will be translated
Bring in,
into
yeah.
this. So in that, like the broad framework that we'd highlighted, I think during the Northern Arc Capital video, was that there are premium NBFCs which are large, fast growth, supremely profitable, credible, and sizable as well,
right?
Which get a 2 to 4%, 2 to 4 times price to book. In general, that is what we've seen. Then there are the mid segment, which is upcoming, budding ones, which get about 1 to 1.5 times book. And then there is the one that may be smaller, a little distressed, have gone through some troubled past, or are going through a transitionary phase or whatever, which will get anywhere between 0 and 1 times
Understood.
book. So that is the general spread, or the general pyramid that you look at, and you see where this one is placed. So this one would be placed in the top tier, because market leadership, very high in terms of size, very credible, also very fast growing and immensely profitable. So that you can take as a benchmark. Then you can get into nitty-gritties of comparing with Manappuram, for example, and give it a premium. Or you can compare it business model wise, where, for example, gold, because it's got a tailwind right now, I would give it a much higher valuation. But I'd be very careful of saying that this valuation may not be sustainable, because these numbers are supernormal and they sort of normalize at some point in time. So then I'll accommodate for a discount. So stuff like that can be up and down. So that's how you would generally look at valuations. If I have to look at the price to book for this company, for example, March 24, it was trading at about 2.4. March 25, it became 3.3. And November 25, it became about 4.5. So valuation re-rating has happened already for this company. The stock has worked immensely well. It is still trading at a steep discount to Bajaj Finance, about a 50% discount, despite higher growth. But how much attribution, or how much weight do you want to give it to that growth, right? Because if it's not sustainable, then I wouldn't say the valuation should converge. So I wouldn't really take that too seriously. Second is the longevity. Not second, it's connected. The longevity itself is questionable of the supernormal growth coming in. So that is again a problem. And because of the run up, it's already come to a premium valuation. So from here, it becomes difficult to justify a re-rating, especially given the peak that gold and silver have reached. Gold has reached right now. So if your call is that this will continue, this 100% rise in gold that you've seen over the last 2 years, 3 years, will continue over the next 3 years as well, then sure, valuations can sustain and probably converge with some of the other players as well.
But like everything else, gold prices are also cyclical to an extent.
They're also cyclical, and so a lot of people can argue and say it will go one way, and it's a safe haven, and geopolitical issues sort of just result in that rising at this point in time. But I'm not too sure about the how much it's sustainable. And if it's not, if I'm questioning the sustainability of it, I would be very skeptical of paying top valuation for it. The stock is, I mean, the story is played out.
That's true. So, that's true. Makes sense. Also, I think one thing to note is if you're interested in listening to podcasts about NBFCs, we've also covered another NBFC, which is Northern Arc Capital. So you can check that out. That'll be put up somewhere here. This episode of Taking Stock is brought to you by Paterson. Okay, I think the next thing we can get into is the community question. So every week, it's very apt again, the question we've picked. The question from Abhin Singh Raju from Amritsar. And Abhin asks, gold is considered as a safe haven. You literally just mentioned that. Gold is considered as a safe haven, but silver has industrial uses, especially in newer segments like solars, EVs, etc. Does this mean silver will perform better than gold?
First impression, yes.
Okay.
But in principle, the reverse. And I'll tell you why.
The supply will increase?
No. So, see, out of the total demand for silver, 50 to 60% comes from industrial. Right? When it comes to gold, it's only 8 to 10% that comes from industrial demand. There is industrial demand for gold as well, but much lesser. Now, what this essentially does is, it exposes silver to industrial cycles.
Okay.
And industrial cycles are going to be cycles. They're never
Right.
going to be one way.
Correct.
So whenever there's a downturn in industrial demand, it's going to expose silver to downturns.
Right.
Which is not true for gold, because that 8 to 10%, even if that demand dries out, there is 50% of gold which is held in jewelry and 25 to 30% held by central banks.
Understood.
Both of them are not going to sell.
Correct.
So price fluctuations are inherently lower in gold.
Right.
And the exposure to industrial demand is also much lower in gold. So you're right about saying that industrial demand can drive silver prices higher, but the safety that a gold provides will also shield the downside much
Right.
more. And current scenario, if I look at the price disparity between gold and silver has actually widened. The historical average of this price disparity is roughly 66:1.
Right.
Currently, it is almost at a 90:1 or 100:1. So the question is whether industrial demand, which is rising, will make gold prices shoot up. Yes, but it has silver prices shoot up. Yes, but it has made gold prices shoot up even more.
Correct.
So.
Makes sense. So essentially, I mean, at the time of recording, silver is also currently at its all-time high or close to its all-time high.
Both of them are, but the difference between them, that's what, gold is much higher in that than silver.
Correct.
So if industrial demand surges further, yes, it will continue driving prices. However, also expose equally on the downside or to fluctuations.
Cool. Makes sense. I think that's all for today. Thanks so much for listening. We'll come up with new episodes every Tuesday. Please let us know in the comments which companies you'd like us to cover, which stocks you'd like us to cover, any specific analysis you'd like us to do. And we'll see you next week. Thanks.
Disclaimer. This content is for informational purposes only. None of the stocks, brands or products mentioned are recommendations or endorsements.